All right.
All right. So for our very first Diligence Network, we've got someone really skilled at in underwriting, and I'm going to let her introduce herself. I've known Vessi for about 8 months now or so, and everything we've done together has been an absolute delight. So, Vessi, take it away.
Absolutely. Thanks. First of all, thank you for having me on, Shane. I really look forward to our discussion. But I'm Vessi Kapoulian, a multifamily, former commercial lender turned a multifamily investor. I help investors new to multifamily learn how to effectively and efficiently underwrite deals. And I also manage an active multifamily portfolio.
And what are some of like the big things like you like to go over when you talk about underwriting? What is like the number one problem you see with underwriting today?
Yeah, so it's a very underwriting I like to describe as a way to understand the risk of the deal, how it's mitigated, and model that out in the numbers. And part of that risk analysis involves understanding the market, understanding the property, understanding the operator and their track record, understanding the financials. Very often, I see people dive straight into the numbers, essentially overlooking the market dynamics. And that's a very common mistake. I can go into a few other common mistakes that I encounter, but before I even look at any deal, I usually like to do a market overview, at least a high level overview, see if it triggers any red flags and I can speak to what they are. But understanding the market is key because of those market data points essentially form the inputs or assumptions for our financial model that drive the outputs or the pro forma return and valuation. So ignoring that is a recipe for disaster. And very often people bring deals to me either to provide a second set of eyes or my own opinion. They've spent hours underwriting, plugging in numbers. The first thing I look at is the properties in a war zone or location with multiple shootings. And so my question is, are you aware of that? And if so, are you comfortable with this risk profile? Most of the time people are surprised when they hear that. So before you even start looking at numbers or analyzing the data, I would say take a look at the market and make sure you're comfortable with the profile and that you understand the underlying market dynamics.
No, it's definitely very important because actually that's one of the few parts of underwriting that kind of we actually kind of provide in our real estate reports is we actually do go in, look at crime rates, even like wildfires, storm data, anything that we think might not have been touched in the initial underwriting. We'll actually put that into our reports if you say, hey, they want me to invest in this property or they want me to work here or they want me to raise capital for this property. We'll look into that specific property to make sure not only that our clients' underwriting
Mhm.
covered all the bases, but that they're the syndicators not kind of like selling them off the river, making sure that hey, this is like a really great property. We have all this cool stuff.
Mhm.
Uh, it's in a great neighborhood, and then we do our full due diligence report, and then suddenly there's like crimes every other day, and tenants are suing them for safety issues. Which when a tenant sues you for a safety issue, that's really crazy because usually it has to be pretty egregious for them to even have cause to do that.
Right, right. Absolutely. Yeah. So, yeah, I couldn't agree more. Understanding that is key in the first step. And there are a lot of publicly available resources that one can tap into to do that type of diligence. Of course, nothing replaces the local boots on the ground knowledge. So I always recommend if you know someone in that market, check in with them. How is that neighborhood or what is it like? If you have an opportunity to visit the property and walk the streets, definitely recommend doing that. Or if you have a trusted third party, like a maybe property manager or a contractor or someone who's physically in that market that can share with you their objective view.
No, that's definitely an important point too because I've Like a lot of real estate fraud, it actually occurs because people invest sight unseen. And
Mm,
if you don't have someone in that market that knows what's kind of going on with the deal, you could get defrauded very easily. I mean, there was a case last year where these former realtors kind of did that exact thing. They said, "Hey, we're investing in this property. We're buying this property." They never bought the property. They kept making excuses why they weren't giving money out to people. And it turns out it was just a big Ponzi scheme, and not even a very good one because the initial investors actually revealed the Ponzi scheme to the government. So it sometimes they're really easy to uncover like that. It's just when someone's kind of sophisticated, they know how the scheme should work. It can
mhm.
take years for you to uncover something like that. And if you have boots on the ground, that mitigates a lot of the risk. You can actually physically see them, or you can have someone be like, "Hey, I know how to look at property records. Let's make sure that sale was actually made before you start investing money in this deal, or let's make sure there's talks to sell this property."
Absolutely. Yeah, no, that makes sense. And so, yeah, so that's definitely step number one. And then probably another common area of misses or mistakes, if you want to call them that, is assumptions. So along the lines of leveraging a local boots on the ground contact, there are a lot of free resources in today's day and age that investors can utilize to validate underlying assumptions with respect to rents, expenses, cap rates. Those are key areas where I see, depending on one's risk tolerance, right? So for me, I personally like to see cash flowing deals, and a lot of people will say that their assumptions are conservative. But what does that really mean? It's how that assumption compares relative to a baseline. So understanding the market dynamics as well as the operator's track record can provide you with that baseline. And from there, you can decide how aggressive or how conservative you want to be with respect to rent growth, expense adjustments, as well as cap rates.
Gotcha. One interesting thing I did encounter recently is, of course, the role like media plays in multifamily syndication. So occasionally you'll get like these sensationalist articles that talk about these deals being underwater. And when you look at them from just like an unbiased perspective, sometimes you don't really find anything. But I would be curious if you ever found a deal like that where you found something in the media that said, "Hey, this guy's deals are underwater," and then you looked at it, underwrote the new deal, and then that one was also not conservatively estimated.
Yeah, so not I haven't necessarily had the match, meaning where I happened to come across the same deal that the press talked about, but have certainly come across cases, unfortunately, on more than one occasion, where, for example, the lead syndicator was representing that the deal is cash flowing and that distributions will be made regularly. But when I peeled the onion, it became very apparent that they were actually raising capital up front from investors. The deal was actually bought with a negative cash flow in year one and year two. And the source of distributions for investors was really the equity that they were raising up front to effectively float the deal. So that would be one area where I would say it's definitely worth peeling the onion. And then as an investor, right, you can make a decision, am I comfortable with that or not? Based on your risk tolerance, risk criteria. Maybe you have excess cash you're looking to deploy, and you see that as a um, better alternative than putting that in the bank, and that's okay as long as you understand that's the case. Um, and then another area I mentioned, as far as one of the key assumptions being cap rates. So a lot of people, especially in the current rate environment where rates are still relatively high, a lot of people expect rates to go down, and maybe they will. I don't necessarily think, based on the data that we have today and based on what we know today, I don't think they'll drop drastically. If anything, they'll hover around that 5 to 6% rate for a while for a variety of reasons. But there are a lot of syndicators who expect rates to go down, and they model out their pro forma valuation accordingly with cap rate compression. And that to me is more or less speculation. In other words, you're hoping the market will get better. And the question I like to ask is, well, what if it doesn't, right? So I personally like to model out cap rate expansion, which basically assumes the market will get worse before it gets better, right? If it doesn't get worse, then at least you've accounted for extra cushion in your valuation to mitigate some of those surprises. But I see that very often. And so the result of an assumption like that could be a deal with 20+% IRR when overall return, right? Or when in fact you may be looking at a deal with a 10% IRR. So again, important to peel the onion and understand that. And then as an investor, you can decide, am I knowing that, understanding that, am I still comfortable with the risk? Does it still align with my own investment thesis?
No, that's definitely important. And I've actually been telling people rightly that hope is not a risk management strategy. It gets a couple laughs, but it's a very true thing. And some people they build out their underwriting based on essentially hope. And even guys like me that aren't skilled in underwriting can spot it pretty quickly because the assumptions just aren't realistic.
Mhm.
If you've got a property and you bought it over market value and then you expect to sell it even higher than that, that's
Mhm.
an issue. If you don't have a strong track record of delivering that kind of result, then your deal is probably not a great investment overall. And that's not investment advice. I'm not an investment advisor. That's
Right,
just my own
right.
personal thoughts on like looking for good deals.
Mhm.
And that's when track record becomes a really big thing because when you have this syndication group that made 30 plus deals and they all kind of fit into that profile of they're a little bit risky, but on the last 28 of those deals, they've delivered it successfully. That
Mhm.
does lower the overall risk of the
Right.
engagement than this new syndicator that comes out here. Hey, I can make this deal that he's basically trying to copy their playbook, but he doesn't have he doesn't have all the plays. He's got like half of it. He's got like half a playbook and he's
Mhm.
trying to win the Super Bowl with it.
Yes, no, that's track record is key, right? Because that also drives how you model the cash flow, how quickly you can stabilize a property, how effectively and efficiently in terms of resources, cash flow, and team members you can leverage to stabilize the property. Of course, when I look at operator track record, there are a few points that I like to look at, and I don't necessarily look for 100% batting average. If you've been in business long enough, at some point you've encountered a challenge, and that could be hopefully not total loss of capital, but it's possible, or maybe performance below projections. But as long as, just like in the example you shared, the majority of deals have or nearly 100%, so 28 out of the 30, right, have performed well. That's something to take into consideration. And then if their assumptions are perhaps slightly different from mine, I will definitely consider that as I determine, am I comfortable with the variance or not?
No, that's definitely important because, like I said, one of the less popular things I do is risk management. So and I've had people, me complete an entire due diligence investigation, say it's high risk, and someone still invest. And that's just because their risk profile was different. They knew what they were getting into. They had all the information now. They looked at all the issues and they're like, hey, this isn't fraud. It's just a high risk deal. So I'm going to invest in it. And I think I've got stuff on my side that mitigates that risk.
Yes. Yes, no, absolutely. That's the beauty of real estate, right? There's no right or wrong. It's just different, and a deal that maybe I don't like may turn out to be a great deal for you. If you have different investment thesis and different risk tolerance.
No, because I definitely know there's a couple of people out there that are a little bit, they treat it a little bit like the Wild West. Like they'll just toss out a couple investments everywhere and they're like, even one of these pan out. It's kind of like the VC model, how they're like, only 30% of companies we invest with need to actually succeed. And for me, as a risk tolerance person, that's absolutely crazy. But I definitely understand that, yeah, that's actually a viable model.
Yeah, no, I wouldn't. I I share your risk tolerance, and especially when you have other people's capital at stake, right? Other people's money at stake. It's the bar is raised even higher. So just doing more deals and hoping that on average, right, 30% do well and maybe the rest don't. That to me is not a great strategy. But again, I understand there maybe people could disagree with yours and mine approach.
No, and honestly, I have whenever I discuss kind of like what I do with VCs, they have that same thing. They're like, we already kind of know the risks of getting involved with these companies. Some of them are going to fail, some of them are going to be frauds.
Yeah.
And it's kind of funny talking to them because it's like the really risk adverse ones are the ones that I actually work with. And it's kind of one of those things where it's like an overlap of different assets and we work on lot of different areas. So it's kind of funny because sometimes I'll see something that's happening in the multifamily space and it'll be really relevant to another space as well, like working with startups. And I'll just be like, you guys are having the same problem right now.
Yeah,
You're having the same issues.
which is interesting because if you think of VC or startups, right, those are early stage companies, so inherently they come with more risk. And I think at least sophisticated investors understand that. With real estate, and of course there are different types of asset classes, different types of business plans, but generally speaking, right, if you buy an existing property that's up and running, yes, there is an opportunity to add certain amount of value and force appreciation, but you're not talking about a complete startup. So
Yeah.
in that case, I think adjusting the criteria is appropriate. Whereas with a VC, yes, you do take on a lot more risk, but the returns potentially are higher, and so is the probability for loss.
I do have a couple of questions for you actually that were sent
Mhm.
in
Yep.
before the meeting, but one of them was kind of weird. So whenever I talk about kind of what I do, I sometimes have really interesting stories
Uh-huh.
about like the different things I've investigated. Of course, I don't use names because
Of course.
confidentiality and all that, but sometimes I'll tell really ridiculous stories and people will be like, is that something that actually happened? I'm like, yeah, this stuff happens all the time. Have you ever had something like happen that not just in underwriting, but in investing as well, where you just had a kind of off the wall story you wanted to share?
I'm like a learning experience or just so I can understand the question better.
Yeah, a learning experience would be great because I always tell mine from that lens.
Yeah. Yeah, probably one, and I actually shared that in my blog as well as profile. It was a deal that I was passively invested in. It was not multifamily, it was a completely different asset class. And long story short, it's been the saga on this one has been going on, and the latest developments suggest that more likely than not it's fraud. And so that was a very tough pill to swallow. Swallowing the loss to begin with, but learning now subsequently that it was a loss. And I have actually uncovered, fortunately or unfortunately, depending on how you choose to look at it, in my former commercial lender career, I was able to uncover two fraud schemes. This one I wasn't able to catch, unfortunately. And the difference between the two is that at least there is a lender. I was in control of the deal, in control of the money flow. For this one in particular, I was an LP. But a few things that I will probably do differently next time is vet the diligence that the lead syndicator or deal sponsor slash fund manager performs on the deal. In this case, it turns out that there was lack of monitoring of performance, and the sponsors may or may not have caught the fraud, especially if the numbers are manipulated, right? Because that's another question to consider. But the fact that it wasn't monitored for years only makes it easier for the fraud to perpetuate itself and extend over a prolonged period of time. Number two is not only understand the business, but also what are the control prongs that exist. In this case, there were no audited financials, there was no third-party oversight specifically for the fund that I invested through. And as it turns out, the lead sponsors didn't really have control over the deal. The operator structured the agreements in a way where they had full control of the money flow and operations, which then later created some challenges with reclaiming control of operations as well as the money flow. And last but not least, in that case, that particular deal reminded me very much of the Bernie Madoff situation, where it was an operator or a group rather that had seamless track record, 10 plus years, clean background checks, um, no history of capital calls or pause distributions, including during down cycles. I mean, everything you want to see in a checkbox was there, yet again, it turned out to be a fraud. So I don't want to discourage people. Yes, check the track record, do deep background checks, make sure you don't fall for social media personalities as well. But always verify before you trust. So in this case, I'm not really sure what I could have done differently because I looked at all these things, including talking to current and past investors. I got all the references and everything checked back positive. But just because someone has that track record doesn't mean, I guess that would be the takeaway. It doesn't mean you shouldn't look closely under the hood, just to make sure everything checks out. All T's are crossed and all I's are dotted.
Yeah. No, that's definitely a big thing because even people with really great track records can get off the track sometimes,
Mhm.
so to speak. And if you're not very careful and meticulous about how you go from how your risk management structure is, like you go underwriting, you go this, you go that, and then you invest. And if you're not doing that every single time, the consequences are unfortunately that sometimes it's not always fraud. Sometimes it's just a bad deal that you get into and they pause distributions. They're really nice about it, which we see that all the time in the multifamily space.
Yeah.
They're really nice about it. They tell you the struggles they're facing. I actually reviewed one where they got hit by a hurricane, and the roof of the property blew off, and their deal they wouldn't actually cover it. Their insurance didn't cover it at all. So you have this case of this syndicator that has almost a spotless track record, not meeting their distributions, not being able to deliver the stuff they're used to investors. But they were
Mm.
very open about it. And when you go into the records of the property, you see they did a capital call, they fixed the property up, and they still have that property to this day.
Right, right. No, I mean transparency is key, right? And properties, investments, they go through challenges. It's not a matter of if, but when. And so being able to openly share, here the challenges, here's how we're resolving them. And I know pausing distribution is unpleasant for everyone, right? It's painful for many people, but sometimes that's the better approach in an effort to conserve liquidity and cash flow, at least in the short run, and hopefully save the property in the long run. And of course, there are a lot more layers to peel to determine if that's just a denial approach, right? Or if it's truly gonna save the deal. But um, being open and upfront in those scenarios is key. Not surprising people, right? Not surprising investors, and laying the groundwork, being communicative of the challenges and the possible outcomes that one may be facing versus sending an email saying surprise, you won't be getting your your check this
Yeah.
month. And unfortunately, that I speak with a lot of investors, and unfortunately, um, that happens more often than I expected to.
No. I did see that Linda joined while we were talking. Linda, do you have any questions for Bessie while where this whole meeting's recorded? So don't worry, you're not going to miss anything. The whole thing's going to be up on a YouTube page. It'll be all over my LinkedIn, so everyone will have access to that, and I'll summarize that at the end so everyone knows where to find it. But did you have any questions? Maybe, but while we're waiting, I'll go on to my next question. I had a newer, it wasn't the same one I sent you the other day, but I had a newer real estate investor reach out to me and was kind of curious, like, what's the actual cost when you go into like an underwriting class or something? What's the typical cost associated with it? Because he was like, do I need to vet all these people that I'm thinking about taking underwriting classes? And I was like, not really. You probably shouldn't do that. My services are way too intense for that. Please don't vet everyone you try to take an underwriting class with, unless they start asking you to spend 20K. And then I'm just going to tell you right out, don't buy that course.
Yes. No, it depends. I mean, it's hard for me to say because sometimes there are bigger, like larger programs or masterminds that may have an underwriting component or course as part of it, right? So in that case, it may be a $20,000 mastermind, but it comes with 1,000 people network and all sorts of courses, events, right? And um, so the cost would vary, but I do offer an underwriting course that's specifically geared towards investors new to multifamily. Some of my students have been passive investors, some are active investors, some are focused on attracting capital, so active investors, but more focused on the capital raising side. So um, that's been helpful for people. It is based on the feedback I'm getting from my students, but that's just solely a course program. It's not part of one of those larger masterminds that I referred to earlier. So it's a lot more cost-effective option for those who are really looking to hone in and focus on underwriting.
No, and that's very important because especially as like single investors, a lot of the times they don't have the capital of just, oh, let's drop 20K here for this course or that course and then just go in kind of do that every time. So affordability is a very, very big thing for them. And that's something I encountered and why I've actually feel like my service is a little bit more useful than some of the existing ones is because I'm more affordable. That's
Mhm.
literally the line.
Mhm.
Um, Less sophisticated investors, they're dropping 50K on a deal. They don't want to play 18K for due diligence on it.
Right, right. No, that makes a big difference, and I tend to view it as an investment, right? You can definitely do it on your own, but you may miss certain areas, and at the end of the day, when you're investing 50 to 100K in a deal, you want to ensure you properly vet the market, the operators, the numbers as well. And these are skills, especially when it comes to underwriting. Due diligence, I wouldn't do on my own, even if I knew what was entailed. So I would continue to partner with firms like yours who do a deeper dive. And to me, again, I view it as an investment, not as a cost, and again, as a way to protect your capital. And ideally, if there are any traps, uncover those before you wire your money. But specifically with other programs like, for example, underwriting, right? It's my goal is to teach people how to fish ultimately, right? And hopefully, they can walk away with skills that they can apply to any deal presented to them, either to co-GP on or to passively invest in multifamily, so they can quickly pick it apart and then realize, am I comfortable with this or not, and should I invest or not? The last thing you want is blindly sending your money just because um, a friend of a friend recommended this deal to you without looking into it, because I feel like sometimes that social element or herd mentality, right, may result in decisions that you may regret later on if you haven't yourself vetted the numbers to determine if that's something you're comfortable with or not.
Definitely. And I think that's about our time. But just to kind of recap what we talked about, it's underwriting is very essential to the due diligence process, and it's something you can do on your own once you learn how to do it. So it's a very good stopgap measure to make sure you're not spending a huge amount of money betting every single deal you might want to invest in. You can learn how to do it, and you can contact Vessi to learn how to do it, and you can go in, underwrite the deal before you send it to someone like me and spend $1,000 on a report and go, hey, this matches everything I need. Let's go deeper. Let's make sure we check all our boxes. Let's check the team. Let's do everything we do so we can invest safely. And that's really what the Diligence Network is about, is helping people invest safely. Um, I absolutely hate hearing people tell me stories about times they've been defrauded. And honestly, whenever someone mentions fraud, I actually ask them, hey, would you mind if I looked into that person or looked into that company so that I can make sure that my investigations would have detected it first. Um, but when you're investing, you have to have all the steps in place, and the Diligence Network is here to help you make the team that you need to do that.
Absolutely. No, I really appreciate you having me on. And yes, measure twice, cut once, right? Is a good old saying, and diligence is part of that process.